The check hit the table and a number made the room go quiet. In that moment I learned this truth. Taxes aren't fate, they're an expense to manage. This story isn't about hiding money, it's about legal planning and structure. The wealthy use timing, classification, and entities to shape outcomes. Ahead, I'll show 5 ways they legally reduce taxes and how to think about using them. This story is about legal tools and the mindset to use them, not hiding money, not breaking rules. Understand them and plan. Think of taxes like weather. You cannot stop the storm, but you can build a roof that keeps you dry. We will walk through 5 ways the wealthy lower taxes legally: timing, structure, classification, allowances, and giving. You will hear simple human stories, so ideas land, not just terms. Quick ask: if this helps, tap like and subscribe. As you listen, note one idea you can use today. Learn, plan, then act. The first story is about timing and patience. Meet Elena, a designer who sold a small e-commerce company for a modest sum. She could have taken the check and paid ordinary income tax rates on consulting income and short-term gains. Instead, she and her tax advisor focused on long-term capital gains and timing. A sale that is structured to generate long-term gains has tax treatment that rewards patience. Elena waited, planned, and matched her sale and reinvestment windows to the tax calendar. The result was not less tax on principal, but better tax treatment over time because she converted what would have been ordinary income into long-term capital gains. The principle is simple. Wealthy people are obsessed with timing. They care about when income is recognized because the calendar and classification of income matter enormously. They will frequently defer income until it can be taxed more favorably, or accelerate deductions into a year where they expect a higher rate, using timing as a lever. The second story is about structure and separation. Think about the mechanic who becomes the owner. Ben started with a single repair bay. As the business grew, he converted the operation into a legal entity and then used a collection of smaller entities to isolate risk and allocate income in tax-advantageous ways. This is not about clever tricks. It is about using corporate structures and legal entities to separate personal income from business profits. Corporations and certain types of pass-through entities have different tax rules. The wealthy place income into structures that allow them to reinvest profits at lower effective tax rates, to distribute income in planned ways, and to take advantage of deductions and credits available to businesses. When companies pay salaries, fund retirement plans, or invest in equipment, those expenditures often reduce taxable income while building enterprise value. Structuring is a way to turn raw revenue into assets that compound tax efficiently. A third story is about the art of claims and allowances. Meet Priya, who owns apartment buildings. Priya uses a powerful tool that many people do not fully appreciate: depreciation. When she buys a property, she does not see a house. She sees an asset that can be depreciated. Depreciation is an accounting method that recognizes the cost of an asset over time and can reduce reported taxable income even while cash flow remains positive. Add to that cost segregation studies, which reclassify some parts of a building into shorter-lived categories for accelerated depreciation, and the effect multiplies. Priya's cash in hand can remain strong while taxable income is suppressed in early years. The wealthy routinely use accelerated depreciation, cost segregation, and other allowances to legally lower taxable income while keeping the underlying asset and its cash flow. The fourth story shows how the wealthy convert income into different forms that receive favorable treatment. Consider Andre, a serial entrepreneur who prefers owning businesses and investing in equity rather than earning high salaries. Dividends, qualified business income, long-term capital gains, and certain kinds of carried interest are taxed at different rates than ordinary wages. Andre structures compensation and investment so that an increasing portion of his return comes in the form of capital gains, dividends, or partnership distributions. He pays lower rates because the tax code treats these forms of return differently. This is not cheatery. It is classification. It is how the wealthy transform work into ownership, and ownership into returns that the tax code has designed to encourage. The fifth story is about giving and legacy. I want you to meet Rosa, who, after selling her company, established a charitable family foundation and used donor-advised funds. She did this because philanthropy can be a tax-efficient way to move wealth while also directing real, social good. Charitable giving can generate immediate deductions, allow donors to control the timing of grants, and support projects that matter to a family. Beyond philanthropy, wealthy families use trusts and estate planning to move wealth across generations while minimizing estate taxes. Trusts, life insurance, and gifting strategies are complex but legally powerful tools for legacy planning. They allow families to hand off capital in structured ways that reduce tax friction. Stop here for a second and listen. None of these strategies are illegal. They are married to rules in the tax code that wealthy people simply know better or apply more consistently. The difference between those who pay more and those who pay less often comes down to education and planning. If you find this useful and you want more practical frameworks like this delivered regularly, take a moment to like this video and subscribe. It helps the channel grow and brings more people into conversations that change lives. Now let us deepen our understanding by exploring how these ideas translate into specific thematic practices without crossing into reckless instruction. First, the wealthy minimize taxable earnings by converting labor income into capital income. That conversion is not mystical. It is a deliberate choice to build or buy assets that produce returns. An artist who sells prints and then licenses work to publishers is moving from marginal sales to recurring royalties. A software founder who retains equity rather than selling himself out early retains the opportunity for capital gains on the eventual sale. The wealthy choose ownership when possible. Second, they harvest losses to offset gains. It sounds small, but harvesting losses is a disciplined approach. When markets fall or an investment underperforms, those losses can be used to offset gains elsewhere, reducing tax bills. Wealthy investors maintain diversified portfolios and tax loss harvesting rhythms. They do not panic sell out of fear. They use market movements to balance tax outcomes. Third, the wealthy use retirement and tax-advantaged accounts strategically. Defined benefit plans, deferred compensation, and certain retirement vehicles allow complex deferral strategies that are simply out of reach to someone earning only wages and paying high marginal rates each year. These tools let a person postpone tax liability into later years, ideally when their tax rate may be lower. The wealthy also invest through captive insurance, family-limited partnerships, and managed entities, where the interplay of business expenses and retained earnings create tax efficiency. Fourth, they use credits and incentives that exist for economic development. Governments provide tax credits for research and development, for investing in underserved zones, for creating jobs. The wealthy and their advisors know where to look. Investing in certain types of businesses, rehabilitation projects, or community development funds produces not only potential returns, but also valuable tax incentives. This is economic policy doing what it is supposed to do, and those who align capital with policy can reduce tax liability legally. Fifth, the wealthy protect themselves against audit and reputational risk by documenting everything and operating transparently. The difference between legal planning and dangerous evasion is documentation and compliance. The wealthy keep records, use reputable advisors, and structure transactions so they will withstand scrutiny. They accept that the tax system has rules and they prepare their case in advance if questions arise. That is part of the cost of playing at scale. We must also address international considerations. Wealthy individuals sometimes use international diversification and legal residency planning to achieve tax advantages. Country residency, treaty benefits, and careful international structuring can change the tax outcome for income earned across borders. That said, these strategies are intricate and increasingly regulated. The wealthy who employ them do so through careful counsel and full compliance with disclosure rules. The lesson is not to fantasize about hiding wealth offshore. The lesson is that the wealthy are mobile in thought and often global in practice. They understand jurisdictional differences and align their activities accordingly. Let us return to humans and habits. The wealthy are disproportionately invested in knowledge networks. They hire tax professionals, lawyers, and accountants not as occasional advisors, but as ongoing partners. They run quarterly meetings to review tax position, and they think about taxes when they sign contracts or buy assets, not as a rearview mirror complaint. Taxes are part of the business plan. This is a key behavioral difference. The middle class treats taxes like an annual punishment. The wealthy treat them like a recurring operating expense to manage. There is also a cultural edge. The wealthy are comfortable with complexity. While the average person might avoid anything that feels bureaucratic, wealthy people lean into complexity to find opportunity. They read policy memos, attend briefings, and hire specialists who can translate dense rules into advantage. Complexity is a moat if you know how to cross it. A quick parable may help. Imagine two gardeners. One tosses seeds into the dirt without thought, and then complains about weeds and poor yield. The other studies soil composition, waters with a schedule, plants complementary species, and rotates crops. After a few seasons, the second gardener harvests far more. Taxes are like soil. Those who tend it with knowledge and consistency grow richer harvests. Now, a handful of practical, high-level suggestions that anyone can apply without risk. First, learn. Start with the basics of income types, how capital gains differ from ordinary income, and the broad strokes of deductions and credits. Second, document. Keep receipts, contracts, and a simple ledger. The record is your shield. Third, time your decisions. A small delay or acceleration of a sale or deduction can alter your tax outcome. Fourth, build assets. Regardless of your income scale, converting part of your effort into ownership is the single most reliable path toward tax-efficient wealth. Fifth, consult a professional. A qualified accountant or tax attorney will translate the legal options available to your situation and help you avoid pitfalls. If you are wondering about moral questions, that is healthy. Avoiding unnecessary taxes while staying within the law is not the same as evasion. There is a moral choice to be made about how much to pay and how transparent the choices should be. Some wealthy families give generously because they believe wealth carries responsibility. Others focus on preserving capital for descendants. Both paths require sober choices. We are nearing the end of the story and the lessons are clear. The wealthy avoid paying taxes not by breaking rules but by understanding them, planning ahead, structuring income and assets, leveraging timing, and using legal tools that are available to anyone willing to learn. The difference is not a secret handshake. It is a commitment to strategy and a willingness to plan years in advance. Think back to Jake and his Uncle Martin at that dinner. Jake left not with a single cheat sheet but with a new orientation. He began to think about how each decision would play out in taxes, about how to convert income into assets, and about building relationships with advisors before he needed them. That is the essential truth. Taxes are complex but conquerable. They are not a destiny to accept with a shrug. They are a system to engage with. If this story moved you, here are 3 small actions to take this week. First, run a quick inventory of your income types, assets, and liabilities. Second, pick one professional resource, even a single consult, and schedule a conversation about tax strategy. Third, commit to learning one concept this month, whether it is depreciation, tax loss harvesting, or how retirement accounts work. Small steps accumulate. Remember that tax planning is a long game. It rewards patience, documentation, and thoughtful risk. The wealthy are not exempt from the rules, they just live inside those rules with intention. I will close with a caution and an encouragement. Caution because the line between legal optimization and illegal evasion can be thin if you seek shortcuts. Always operate transparently and seek counsel. Encouragement because the rules are not fixed traps. They are systems that can be understood and navigated. Wealth often grows where knowledge meets action. I am not a financial advisor. The ideas in this story are for education and should be discussed with a qualified professional who understands your specific circumstances. If you found this helpful, please like this video and subscribe for more deep dives into the systems that shape money and freedom. Comment below with one question you have about tax strategy and I will try to answer it in a future video. Understanding how the rich avoid paying taxes is not about envy, it is about learning the language of wealth. Once you learn it, you do not have to be wealthy to use it. You only need a willingness to think long-term and act with clarity. That is where the real advantage begins.